Mm.
Hello.
Hello. How are you?
Good. How are you today?
I'm very good, very good. Are you in your home office?
I am. Just did my snow blowing about an hour ago, so I'm done with that.
We are doing that right now. I said my husband and I are actually the presidents of our association of four houses, but he's out there just shoveling away.
What do you mean an association, like a condo association?
Yeah,
Oh, wow. No kidding.
yeah, because I need that job, Dean. How are you
Yeah,
though?
like
Everything good?
I'm good. Very well, thank you.
Yeah, same here.
Very well, very well. So, yeah,
I'm just gonna be.
I wasn't sure if you were gonna keep this today or not, considering the weather report that we had got, even though it really wasn't as bad as they said it was gonna be.
I know.
But I'm glad that you did. So we moving on.
No, we have quite a few people that have registered as well. We are going live inside of the Bergen County Partners Group, and I'm also going live inside of the coaching lobby. So I'm the director of productivity now with the Ridgewood and the Tenafly Market Centers.
Good for you. That's a big position.
Yes, and
Congratulations.
thank you very much. I'm very proud to be there. I love it. I love the agents. The opportunity is phenomenal. I mean, one of the things I can say is because we have such great visionaries at the top inside this organization, they're able to build all these passive income opportunities for our agents. So it's not only, like I was talking with you, um, it's not only about the sales. It's not about the active income. It's about what could we do with that active income? How do we passively
That's right.
make that work for us? So
That's right. Leveraging active income into passive income opportunities is how people make money in this world. You can't rely every year on producing. First of all, some people burn out, some people have lulls, they have good years, not so good years. But if your money that you've made for you is working for you in other ways, you're still always going in the right direction.
not that I'm just realizing it. It's just during this weird COVID time, it gave us really time to reassess everything, look at all of our assets, restructure some stuff, get rid of debt. We took a couple of financial classes because everything was available on Zoom and for free. And we really took advantage of that stuff. And my husband and I got really financially sound.
Great.
And then it's where do we build from this point forward, and with the industry being so potentially different in the next few years, um, making sure that we are bulletproofing our financial stability. And I think
Right.
that's a lot of people in our organization. I think that's where their head is right now. Is what's the next few years going to bring in real estate, and how do I make sure that my lifestyle is not affected and I'm continuing on the path of preparing for that retirement. Um, so we're having some good conversation right now, but we didn't get started because it's 10:59. I do see that there's 18 people on. Sally's going to be coming on as well, and we are live. So I mean, I guess you're ready. I'm ready, right?
I'm ready whenever you're ready.
Okay, so those of you who are watching, thank you. Welcome. Mary Beth Olive, Director of Productivity, Ridgewood and Tenafly. And we are part of this amazing organization, Bergen County Partners, where our five sister offices are killing it right now. Dean, we were just recognized in Bergen Magazine as the best brokerage in Bergen. And we have, over 1,500 agents in our organization, and we're proud to be in business with them. So Dean Symeonides is our accountant for all five market centers. And Dean and I know each other from when I launched the Hoboken Market Center, and I spent some time in Dean's office with the leaders there. And so I was happy to know that he is here as well. And he's been an amazing resource when I've gone through setting up the market center and having questions on how to structure certain things. So I know he's going to be a wealth of knowledge for everyone. And Dean, I heard that you were doing some of this when COVID just started also. So some of our guests should be familiar with you. Is that right?
Yes, when COVID first started, the whole PPP was introduced, and that was very confusing to the average person because it was rolled out very, very quickly.
Yeah.
It's not something we've had precedent on, so it's brand new information. So it was confusing. It needed explanation. It needed further explanation. Unemployment benefits kind of muddied the waters, whether people would get both. What should we do, one or the other? There was all kinds of questions about that. So that was pretty involved back then. So
Yeah.
we're all these months later. I think there's a little more clarity now than there was then, I would hope. But back then it was kind of muddy, no doubt.
Interesting. I still think that money, I mean, I know at certain market centers, that money was it was a cushion, and it'd be interesting to see what the government does as far as, are they going to forgive it? Will it be used, back into the market centers, or, it's interesting to me because for some of us, we did a really great job at managing our expenses and maybe didn't need to tap into it as much as some others. But Sally Ponchek has joined us.
Hi,
Welcome,
Dean.
Sally.
Thanks,
hey, Sally,
for
how
coming.
are you?
I'm great.
Nice to see you, Sally.
I
How's
love
everything
Sally.
with you and your family?
Good. Everything's good, Sally, with Sally's family?
Everything
Good.
is good. Yeah.
Great, thank God.
So,
Thank
Dean,
God.
can you introduce yourself, kind of say who you are, what you do, where you are, and then let's just get into some information. And if anybody is out there and has a question, I would ask you to go ahead and put it in the chat so that we can make sure that Dean can address it. I know we had some questions about, does an agent set up an LLC, an S Corp, and maybe we can get to that towards the end. But I know you have some topics that you wanted to discuss, and Sally and I can guide you a little bit as well.
Okay, so let me introduce myself. As Mary Beth said, I'm a CPA. I'm the accountant for the Bergen County Partners Market Centers, as well as some other Keller Williams organizations as well. So been doing this for a number of years. One of my expertise is real estate, of course, among some others. But I'm a CPA licensed in New Jersey and Florida. I have a varied practice from real estate to manufacturers to professionals like doctors and lawyers to retailers. Over 35 years of being in business, you get a little bit of everybody. I do a lot of tax work, a lot of financial statement work, a lot of budgeting, work with a lot of banks. So this is what I do full time. I don't do any other type of work except for business valuation and exit planning. So business valuation is what it is. I'm able to, through my certifications, put a value to a business and issue a report. And I also am experienced as an exit planner, somebody who wants to exit their business. What are the steps to do that? How to maximize profits, how to maximize the deal. So this is what I do. As far as taxes and accounting is concerned, I think that's the focus of what we're discussing today. And in terms of real estate, I'm happy to get into whatever topics you, Mary Beth, would like me to discuss and take the questions.
Okay, awesome. Well, and Sally, if you have some questions as well, I just want to make sure you're unmuted, right?
Yeah. I think the biggest things are, how can they save money on their taxes and what should they be gathering to put together for their accountant, or even just to do their own taxes.
And best strategies at organizing themselves throughout the year so that they can be prepared.
Yeah.
Okay, so with your permission, I can start to discuss that.
Absolutely.
Okay, so the biggest problem is self-employed people are pretty good at what they do, but the problem is that they're not very good generally in organizing their finances, and they wait to the last minute when they finally realize they have to file a tax return that they start to try to get their act together and put together their numbers. Mm-hmm. Invariably, that person is going to lose tax deductions because doing it quickly and trying to gather 12 months of information in one sitting or so, you're going to lose tax deductions. So organization is the first key. So we're ending 2020 right now, and thank God, let's kick 2020 to the curb from this COVID thing. But this is a good time to start 2021 as well, because organization starts early. So we're starting a new year. My recommendations start fresh. So how do you do that? You either do it through some sort of organizational computer software like Quicken or QuickBooks, which is not difficult. It should not be something that people get scared about and have to learn a new thing. And oh my God, I'm not an accountant. It's not like that. It's fairly simple to use. It just takes a little instruction possibly, but really not much. And then you can organize and enter your transactions on the fly, whether they're credit card transactions, checking transactions, your income. It's all being done on the fly. And if you're diligent with this, or you have an accounting firm such as mine to do it for you, which I do in many cases, it all depends on the situation, you're going to ensure that you're gathering all of your potential deductions. So that's important, whether it's travel, your car, your dues, the supplies that you use in your office, your home office for that matter. Everything, every dollar you spend as a self-employed person should be looked at as a potential tax deduction. Of course, there are certain deductions or certain payments that are personal in nature. Your trip to Hawaii, hard to argue that's not a personal expense, okay? Things like this that are blatantly personal, obviously we don't consider, but there's a lot of gray area in accounting and taxes. Something that looks personal as an expense from the outset might have an element of business to it, because let's face it, we as self-employed people are always on. We are always trying to gain more benefit, always trying to sell our service, no matter where we are and what we're doing. That's how I am. I've been that way for 35 years. I'm going to suspect many people on this call are the same way. So with that in mind, what you're spending money on can be tied to your business. So organization and gathering everything and making sure nothing is slipping through the cracks is the number one thing to make sure that you are going to get your full deductions. Now, there are checklists. For example.
Now, Dean, time out for a second.
Yes.
We do have a question from time out. So we have a question from Scott Stewart on that, which is great. He's asking, do you recommend any specific bookkeeper who can set up an MREA chart of accounts or possibly maintain monthly bookkeeping in QuickBooks? Is there somewhere or someone that you recommend as a bookkeeper that would be able to do that?
I work with a number of bookkeepers. Many of them are out of the area. They work remotely. Arizona, California, Texas, whatever. Are there one or two in New Jersey? Yes, but the person that employs this outside bookkeeper to set up the chart of accounts and maintain QuickBooks, you have to get comfortable allowing this person, who you do not know right now, to get involved with your banking transactions, your credit card transactions, and maintain some sort of set of books for you. But you have to have a comfort level in order to do that. Now, I can make recommendations. However, it's up to you to get that comfort level. But absolutely, the answer to the question is yes, I do have some people I could refer.
Thank you.
Okay.
Okay.
Next question I see here is what about virtual bookkeepers like bench.com? Yeah, they can be helpful as well. You have to have that comfort level because, like I said, you're giving them proprietary information about yourself. They have to have access to your bank statements, your credit card statements. You don't give that out to just anybody. So this has to become from recommendation as far as I'm concerned only. And then there's no guarantees either. So there has to be some surety that you're not going to get hacked or somebody's going to take your information and do something bad with it. That's the risk of these virtual and outside bookkeepers. But they serve a great purpose for people like us that are busy. They serve a purpose of gathering this data. So most people have a pretty good success rate with them, I have to say.
Okay. So what I heard from you though is organization. And going back to that for a second, do you suggest, I mean, I guess this is probably a personal preference, business credit cards to keep organized? Do you suggest
Yes.
that kind of tracking?
I think what I suggest, and a lot of realtors do not do this, is I suggest a separate account for your real estate activity, a bank account I'm talking about, and a separate credit card that's tied just to your real estate activity. Your personal checking account and your personal credit card should not be involved in your business. You want to have a separation between your business and your personal life. So your business account, checking account, you would deposit all of your commission income. You would pay all of your expenses out of, whether they're debit cards, your credit card for your business name should be paid from your business account. And as you want money for your personal use to pay your mortgage and any personal bills you have, you just simply funnel or transfer from your business account over to your personal account. Just a transaction. These days it's so easy. You just do it on your banking app. But you want to separate your business from your personal banking. That way, there's no decision making. Everything in your business checking account that you recorded is a business expense. Everything on the credit card for the business is a business expense. It takes a lot of the guesswork out of it.
Okay, so to that, and I would suggest whether you just got started, some people might be thinking in their minds, well, I don't have a big business yet, so I shouldn't get into this until my business grows. This is a great habit to get going from the beginning of your business, because all of this, especially in the first couple of years where you are putting money into the business so that you can have a business that you receive referrals, that you receive business from, you're going to lay money out. So that organizational, operational startup money is, you got to keep that accountable. Even buying equipment, right? Setting up your home
That's
office.
right.
What are you seeing this year as far as natural expenses that agents should be considering that they are business expenses? What's stuff that's coming up new?
You mean this particular year in question?
Yeah, and all years, but what's stuff that they might not have been
Well,
thinking about
home
in past
office,
years?
the home office is a big deal, especially this year where people are working remotely. So setting up your home office with computers, a desk, maybe you painted it, you decorated it in case you did see any clients. Anything you needed in those four walls of your office is a deduction, 100% deductible. IT costs, you want to allocate your internet. I'm sure your internet access is for the entire house. We want to allocate a good portion of that to your business because you're using it predominantly for your business. Same with your cell phone, okay? We also, there's two ways to take a home office from the IRS standpoint. There's a full-blown take as much deduction as I can method, or there's a simplified method. Now, this has been an abused deduction over the years, and the IRS used to come out and actually knock on doors. Sorry about that. They used to come out and knock on doors, clear that, and see if you actually had a home office. So, but they do acknowledge that home office does exist, especially this year with COVID. So they give you two options. The simplified method is, hey, we're going to give you a deduction. It's not going to be as big as what you probably could get if you put the full-blown deduction together. But this is going to be a deduction that we're not going to bother you about. We're going to give you something and we're going to leave you alone. If you want to go for the full-blown deduction and put everything against the wall as possible for that home office deduction, you're setting yourself up for risk that they're going to question you. Because they've given you that olive branch of the simplified method, they've told us that they're going to be a little more aggressive in looking at that full-blown deduction on the home office if you choose to go down that route. It doesn't mean it's illegitimate. It just means it could be questioned. The simplified method hardly, if ever, is questioned. Okay, but home office deduction is a valuable deduction, and we can't overlook that. It's based upon square footage of your workspace compared to the whole house. And even your exterior costs are part of this. Your landscaping for your home, for example. Well, your one office room does benefit from landscaping, doesn't it? The whole house benefits, that room also benefits. Your utility bill for public service or Jersey City Power and Light, whatever it happens to be, you get a share of that for your home office. So that is something that has to be accounted for and not forgotten tax time.
Snow removal today?
Snow removal counts too.
Okay.
Counts as well.
Karen asked, she has with a one-bedroom condo, but using the living room as an office, can it be deducted? It doesn't necessarily have to be a physical office room. It's just that you're operating out of your home.
We have to, there is an actual rule that the IRS has that it has to be a dedicated space just for your business. That's what the IRS rule says. Practically speaking, though, that doesn't always work that way. Just like in Karen's question, she doesn't have that possibly. She uses her living area. So look, a reasonable square footage for her living area that she uses for her business, I would take. I mean, you have to be somewhat practical about this, not follow the letter of how it's written sometimes.
You said that question right there is, are there any implications to claiming the home office deduction when you sell your house?
If you take depreciation deduction, their answer is yes. When you take the full-blown deduction, and I'm defining that as every possible expense you can allocate it to your percentage of business use for your home, you're supposed to take a depreciation deduction as well. If you take a depreciation deduction, that is you're saying that this one office is a business. So if you were to sell your home at the time when you are actually running a home office through it, theoretically, you're not allowed to claim the $500,000 exclusion on gain on that one room because you're saying this is a business. Think of that one room as a separate office building someplace outside of your home. That's how the IRS looks at this. So there is a potential for a capital gain if and when you sell your home and it's still a business. Now, my recommendation would be if you can structure this that it's not a home office in the year that you happen to be selling your business, that might be a tax strategy you might want to employ. But what the depreciation does is it reduces your cost basis, and reducing your cost basis on an appreciated asset works against somebody when they are selling it for a profit. So you want to try to structure your timing of selling your home when your home office is not part of the mix.
Okay. All right. Yes, to Mike Kaplan, we spoke about that. The heating, oil, electric, AC, we could count a portion of that to our home office. Homeowners insurance. I mean, I think that's
a no-brainer.
Yeah. Anything that is giving you the ability to operate out of your home office.
Every expense for your home, every expense is a deduction to the percentage of business use, which is basically calculated on a square footage basis. Okay. So everything. Okay. Real estate taxes, mortgage interest, home insurance, landscaping, utilities, cable, everything.
Wow. So this is definitely a point that they're going to need to be speaking with their accountant this year on what to do.
Absolutely. Every dollar counts. I mean, if you're in a 30% bracket, every $100, let's make it a better example. Every $1,000 of deduction we can get, you save $300 in taxes on the federal side alone. I mean, it's you're just throwing money away if you leave these deductions off your return.
Okay, thank you. Now, how about unemployment? That was a big one this year, and maybe some of the spouses are on unemployment. Some of our agents have taken unemployment. How will that affect tax filing for 2020?
Okay, so unemployment is 100% taxable on the federal government side, 100%, at whatever your ordinary income tax rate is. So for people that had a reasonable amount of unemployment that chose not to withhold taxes, they've put themselves in a little bit of a tough position, depending on their other income. Depending on their other income, because as we all may or may not know, the more income you have, as your income rises, your income tax brackets rise with it. So if you take an extreme example of an agent that chose to take unemployment for at least a period of time, but still had a great year in real estate, had a really bang up year in commission income, that person is presumably in a higher tax bracket. And if you're in a higher tax bracket, that unemployment is coming along for the ride, being taxed at that higher bracket. So it's working against you if you didn't have any withholding. The only plus with the unemployment is that it's not taxable in New Jersey. One of the few benefits tax-wise in New Jersey that we get, because usually we get slammed in New Jersey from a tax perspective, but unemployment is not taxable.
Okay. How about Nakia has a question about the gift write-offs. Could you speak to that a little bit as far as the $25 per person? Can we fold this cost of the gift card to be in marketing instead? What do you suggest to your clients?
You got, I mean, the $25 limit the IRS has imposed is ridiculous. That's been on the books for many, many years, but it is the law. And I may think it's ridiculous, and so may you, but it is the law. So we would not want to put $3,000 of gifts on your tax return. We want to say it's something else. It's promotion. It's marketing. I would say call it something other than gift to keep it from sticking out like a sore thumb. Why invite a question from the government? And on that note, the IRS in recent years has not been auditing self-employed people the way they used to, not at the same frequency. It doesn't mean that they're not doing it. They're still doing it, but we don't want to invite them to question you. And a lot of times they don't send agents out. They'll just send you a letter. It says, okay, we're auditing your return, but we're target auditing you. We want to know about your travel and entertainment and your gifts and your office expense. Show us the proof of payment and the receipt for these deductions so we can look at those deductions. That's called a desk audit. We're targeting those particular deductions. So anything you put on your tax return, make sure you have the backup for. Don't be so cavalier that you just deduct it and don't worry about it. It's not the way it works. You have to have some basis and some proof if you ever were questioned.
Now, to the tax bracket, to the actual tax bracket, is there a certain limit as to earnings that would bump you to the next tax bracket?
Correct. There are. Do you want me to? I mean, I don't have it in front of me, but I can certainly just Google that while I'm talking to you.
Okay.
And tell you what those are. I can tell you what those are. Okay.
To Lisa's question, the credit card record, is the credit card record enough, or does she actually need the receipt if she were to get audited?
The IRS has the right to ask for the receipt as well as a proof of payment. Proof of payment is either a credit card, a debit card, a check. Cash is fine too if you're able to show a withdrawal of cash, but you need to have a receipt and a proof of payment. So here are, if you like me, I can tell you what those brackets are now.
Yeah, please.
Okay. So let's talk about married filing jointly. If you are married filing jointly and your taxable income falls within 20,000 and 80,000, and by the way, I'm just rounding these numbers off just for simplicity. You are in the 12% bracket, 20,000 to 80,000 of taxable income. In the 22% bracket, 80,000 to 171,000. 24%, correct. 24% is 172 to 326. And you're in the 32% bracket. Hold on a second here. I just lost my train of thought. 32%, 326 to 415. 35%, 415 to 622. And the highest bracket possible is 37%, which is 622 or more.
Okay.
That's for married filing jointly. The same brackets, if you'd like, I can also kind of speak about the single individual.
Yeah, I
Would you
think
like me to do that?
somebody wanted to know about the single.
Mm-hmm.
Okay, so 12% is $10,000 up to $40,000. 22% is $40,000 to $85,000.
Mm-hmm.
24% is 85 to 163. 32 is 163 to 207. 35 is 207 to 518. And 37% is 518 or more.
So it's pretty
Now,
much half until you get to that 35% bracket. Then it gives a little bit of an extension to that 500,000 on a single.
Right. And I'll just throw out that, tax law may change with a new administration. Tax law may change. It's not official yet, but the new presumed President Biden has said that he wants to raise taxes and bring that 37% up to 39.5%. So that's going to raise our income taxes for the people that are making over 400,000 is what he had said. Let's see if that comes to pass, but I'm just throwing that out as a possibility for 2021.
And we're going to keep that in mind, that that number is the net after all these deductions are taken off of the gross.
That is correct. That is the net. Now, the net is also subject to self-employment tax, which is a term for Social Security and Medicare taxes that have to get paid. And they are also paid on the net profit of that business. So you're paying income tax and Social Security and Medicare tax as a self-employed person on the net profit of your business. That net profit up to a base of about $140,000 is subject to 15.3% Social Security and Medicare taxes combined. 12.4 for Social Security. Yeah, it's wow. 12.4 for Social Security, 2.9 for Medicare. So look at it this way. If you're making a reasonably high amount of money, and that's going to be depending on who you are, what you consider high, you're paying a decent amount of income tax plus Social Security and Medicare taxes that probably combined, and then you add the state income tax, which could go as high as 10%, you're over 50% in a heartbeat. So that's why these deductions that we were kind of speaking about for the first few minutes today are so valuable to you, because you're going to be throwing away 50% or more in taxes otherwise. So the people that don't focus on keeping all their records and are not diligent with saving their receipts or putting together their deductions, they're losing a lot of money, and it's probably every year, which is not good.
So, I just added that up quick because I'm a numbers person. I was like 37. If you're at the top bracket, you're paying 37, you're paying 15.3. And on top of it, you just said about 10% as the max in New Jersey. I'm over 62% is going back to the government in taxes. What do you see?
No. So I just want to point out that the Social Security tax, which is 12.4%, is up to a maximum earned income limit of about 140,000. This number gets indexed every single year. Every year it's a little higher, happens to be right around 140, maybe a little less for 2020. If your earned income, which is realtors, accountants, anybody that works self-employed, once we pass the 140 in earned income, in other words, our profit in our business after those deductions is over 140, the Social Security tax stops. It's capped at that number. The Medicare tax continues for as much money as you possibly can make, and that's 2.9%. Okay. So I don't want people to think the 15.3% that I initially said is for 100% of what they make. It's capped at the 140.
Okay, fair enough. So that 12.4 would be on 140,000 at the max. And then
That's
you'd
right.
only be paying the 2.9, which is the Medicare. Which still is
I'm sorry, go ahead.
It's an astronomical amount of money. What are you advising our agents to do with that money so that they could bring their income down? Is this where they go ahead and write checks for charity or put money in SEPs or IRAs? Like, what do you suggest to them so they're not throwing it away?
Well, there's two questions there. One is itemized deductions, and the other is retirement plan contributions. Itemized deductions are defined as your state and local taxes, your real estate taxes, your mortgage interest, and your charitable donations. That's basically it. I mean, if you have a high amount of medical expenses, that would also count, but that's a little bit of a high threshold to get to. Those are called personal itemized deductions. Your state and local tax deduction is capped at $10,000 under the current law. That means your real estate taxes and whatever you pay to the state of New Jersey, I'm sure most of us are paying more than $10,000 when you combine those two. We're capped at $10,000. Then you add in your mortgage interest and your charitable donations. Now, if those add up to a number that exceeds your standard deduction, then you can take the higher number. The standard deduction for single people is about $12,000, and the standard deduction for a married couple filing jointly is about $24,000. So for the single person, it's not that difficult to get over the $12,000 hurdle because they're giving you the money, that deduction. If you had no mortgage, no real estate taxes, no charities, they give you the $12,000. They give you the $24,000 deduction. But if you do have those and you happen to be over those standard numbers, you get the higher. So my point in telling you this in detail is that married filing jointly, since 24,000 is that threshold, it waters down those other itemized deductions in a great way because they're just giving that to you. Just think about it for a minute. If you have a $10,000 cap on your tax deduction, which is your state and local real estate and income taxes, and then you add in $10,000 for a mortgage deduction, and you add a couple $1,000s for charities, you're still not at 24,000. You're close to it, but you're not at that level. So those deductions basically are wasted. They're gone because the 24 is given to you, right? Do you understand what I'm saying?
Yes.
So itemized deductions are a different ballgame than they used to be. It may change with a new administration. We don't know. I think maximizing the business expenses is the way for most self-employed people to focus their attention on. Now, the other thing, Mary Beth, that you mentioned was retirement plans.
Mm-hmm.
This is another big problem for self-employed people. Why is it a problem? Because many of them don't focus on it and they don't do it. Their accountant like me will say, okay, well, you have a right to contribute 20% of your net profit to a SEP, Simplified Employee Pension. You're going to get a $20,000 tax deduction if you make $100,000 in profit. That's a valuable deduction. I've got to tell you, 8 out of 10 times people say to me, well, that sounds great, but you know what? I don't have the money. I didn't plan for that. Maybe next year. And next year comes and it's the same thing. I think my advice to the self-employed people are, look, the government is giving you this tax deduction. You're paying yourself. You're moving it from one account, a personal account, into a retirement account called a SEP or a solo 401k or whatever it is we set up for you. It's still your money. It's not going anywhere. It's still yours. Okay, it's segregated. You can't use it to pay a vacation or buy a car, but it's your money. They're giving you a tax deduction for this. Why not walk through that door and accept that? And just put it into your head that this is part of your budget. I understand that money can be tight. I get it. But this should be part of everybody's thinking. Hey, if you worked for a company and they offered a 401k, I bet you would contribute to it. You'd be part of it, right? Why not do it for yourself? You have to make that decision yourself when you're self-employed. And in my business, in my practice, I see this as being a problem because many people don't plan for it and therefore they're not ready for the deduction or to make that payment. Because you can actually make the payment up until you file your return. You don't have to make it today. If you filed your return April 15th, you'd have to make your SEP contribution by that date. But let's say you went on extension. And I have a lot of clients that go on extension for this one purpose. They say, okay, Dean, you say I can do $20,000 in the SEP. I don't have the money now, but I'm going to have it in October 15th when the due date for the extended return comes up. Fine, and then we're going to wait to file your return until you have the money because we can now fund that $20,000 for the prior year tax return and save you $20,000 in taxes. So a big issue, and I really recommend everybody focus on it.
So you and I had that conversation prior to this conversation that I think a lot of it is the lack of knowledge of it, or slowing down enough to understand how this is going to affect us 20 years from now, 10 years from now. The question that you said, you sit with your accountant and it's, do you want to put some money into the SEP account? And in that moment, we don't have the money. I would advise everybody that in that moment, set up the SEP account so that you can just feed it every month. And Dean said something really important is it's not in our budget. Put it in your budget. Put it in your budget that you're sending 1,000 away or 500 away or 200. Put it in your budget so that it isn't a big hit at the end of the year, and you did get to, get that tax benefit.
Correct.
Um,
And by the way,
So-
can I just also, I want to point out, Mary Beth, that people
Yeah.
don't have to wait to the last minute to make that contribution. I mean,
Right.
if you know you're going to be profitable, you can start to deposit that money into that account throughout the year. You just can't finish that depositing until we know what the profit of your business is and make the calculation.
Yeah, and that's what I mean is put it in the budget. Even if you're not sending it to the account, then maybe keep it separate in a bank account that you can then go ahead and it's accumulating. Something that my husband and I do, and I've shared this with some of our agents, is just have all those multiple accounts where I have a tax account. The minute any kind of 1099 income comes in, we slide that money over so it's kind of accumulating, and then we can go ahead and send in our what do you call quarterly. Do you suggest them to send in quarterly or let the year run? Does it matter?
No, I 100% suggest quarterly, 100%. So the way this works is if it's done correctly, when we do your tax return for 2020, let's say that's done in March, just as an example. Okay.
Mhm.
We figure out what the bottom line is you owe, or you get the money back, whatever. And then we focus on the coming year. What do you think you're going to do this year? Well, I don't know. Hopefully it's a good year, fine. But if we don't have any other reason, what we do is we take the prior year as an example, and I give you quarterly payments to make, which are prepayments for the current year. Now, why is this good? You are prepaying. You don't have to worry about coming up with a lot of money at one time at the end of the year. So you're giving quarterly payments to the government with a payment coupon. This can be done either electronically or it can be done manually with a check. So there's 4 dates, April 15th, June 15th, September 15th, and January 15th. Those are the 4 quarterly estimated tax dates. If you pay those 4 quarters, at the end of that year, when you do your tax return, you take credit for those payments. It's like the same thing as when you worked for a company. They took money out of your paycheck and you got a W-2 form. You had a credit of how much was taken out of your paycheck. Well, you're making these payments yourself. Now, the government requires this. It's tax compliance to make these payments. If you don't make the payments, that's actually a black eye, because the government's saying to themselves, you're not administering your self-employed business correctly. There's also a penalty to pay if you don't pay these quarterlies. If you pay it all at one time and say, oh, I'll just wait, I'll keep the money, I'll pay it all April 15th, what's the difference? The difference is that there's an underpayment penalty. So depending on how much you owe, you're costing yourself money by making that decision, because the government's going to charge you a penalty for not paying quarterly. So there's a tax compliance issue, there's a budgeting issue, okay, and there's a penalty issue, all reasons to file quarterly. And these quarterlies can be changed during the year. I have clients that call me all the time, in August and September, and they say, Dean, we thought my business was going to do something. It was going to go up or it was going to stay the same, but actually it went down. Do I still have to make these high payments? No, of course not. We can change those payments to make them lower to reflect current reality, or make them higher to reflect current reality.
Okay. So I have on the SEP IRA question, and then I have an LLC question. SEP and IRA, what's the difference? Do you prefer one or the other? You and I talked about coming back and doing another session specifically on investment and financial, financial advisor kind of conversation. But could you just give a little bit of a difference between a SEP and the Roth IRA?
Okay, so the SEP is an acronym for Simplified Employee Pension. The maximum somebody can contribute to that is basically 20% of your net profit. You'll read that it'll say 25%, but that 25% is reduced by certain other deductions, and generally it ends up at 20% of your profit. That does not have to get contributed until you file your return, including extensions. Because I saw there was a question about that, about having to fund that by April 15th. If you go on extension, you can extend the deadline for filing, for paying the SEP as well. And a regular IRA, forget about the Roth for a minute. We'll get back to that in a second. A regular IRA has a limit of $7,000. So if you could contribute $20,000 based upon the profit of your business, and you have the money for it, why would anybody choose a regular IRA, which is capped at $7,000? We wouldn't. So I think a regular IRA would not be for a self-employed person if you can afford to make the higher contribution. A Roth is a completely different animal. A Roth is a opposite definition of a SEP or an IRA. A SEP or an IRA are deductible on your tax return. However, when you withdraw that money down the road, presumably in retirement, that is going to be income to you then. So you're trading today's tax rate, right? Because you're deducting these IRA and SEP benefits at your current high rate as a working commission person for when you retire down the road, when you pull it back, probably at a lower tax bracket, but it is taxable down the road. The Roth is opposite. You can put money into a Roth. However, the Roth is not deductible. It's an after-tax contribution. The benefit of a Roth is that the earnings that you achieve over the years will not be taxable at all, even in retirement. It's a very powerful tool. So if you have the ability to put money into a Roth, I recommend it. It's free money. The earnings are not taxable. The earnings are taxable with a traditional IRA or a 401k. Okay, so it's two opposite viewpoints on retirement. Not everybody can put money into a Roth.
What's the max on the Roth IRA?
It's like $190,000 of income. Once you pass that amount, then you're not eligible to put money into a Roth. And I think it's a little lower for single people, but I'm talking from memory here, about $190,000 for a married filing jointly. So if you're over that limit, then you can't do it.
So you're saying that if you're over that limit, that you net over 190,000 on your tax returns, a Roth IRA is not even a possibility for you?
Not a possibility for you. There is something called a backdoor Roth, which is a little bit of a complicated area. So to answer that question, there is a possibility to do a Roth, but somebody has to learn about the backdoor Roth, which it would be a whole separate session from this one.
Absolutely. Now, we had another question about the LLC, and I have a question about that too, and I know Nakia was asking. So LLC versus S, why would someone set themselves up as an LLC, S Corp? What do you suggest?
Okay. So
and hold on. So the other question is, and Xavier says, his wife, do you recommend separating 1099 income into two separate LLCs if my wife isn't a real estate agent? However, we categorized her income as marketing consulting income because she does the marketing consulting for another business. We currently only have one LLC for the household, but we run all of the income through the LLC.
Well, that's incorrect. The LLC has to have a specific business purpose. If you have a separate business in your household, that should be a separate LLC. You can't have one LLC that includes real estate and marketing, especially when there's two people involved. That's a partnership, by the way. That's not a self-employed person. That's a partnership. Two separate LLCs within the same personal tax return would be for two separate businesses. You could set up a partnership as an LLC. However, they should also be separate business entities. So this issue about LLC and S Corp, I'm asked all the time. So here's the answer to the question. LLCs and corporations are legal entities. Somebody forms them first and foremost for a legal benefit, a liability protection benefit. If you are operating your business as a sole proprietor, not under an LLC, your business and your personal assets are exposed to any claims, any legal claims that you may have done wrong in your business. So your personal assets are on the hook as well. By filing for an LLC, just by doing that, you've put a wall between your business and your personal assets. So if something goes wrong business, somebody could sue you personally, but your attorney could say, listen, I have this LLC for this client. You can't get past the LLC. Only the business assets are exposed, not the personal assets. So I think LLC is a good idea. However, the next question is, what's best, the LLC or the S Corp? The S Corp gives the same legal protections, but which is best from a tax perspective? Well, if you are a single member LLC, you file your tax return through your personal return. You file what's called a Schedule C within your return. If you decided to make your business a corporation, an S corporation, you must file a separate return for your business. Now, the S corporation does have benefits. The LLC does not, from a tax perspective. The LLC gives you zero tax benefits as opposed to not being an LLC. It's just a legal protection. People seem to think it's a tax saving vehicle. Zero benefits for an LLC, okay? The S Corp is the proper entity to save taxes if the situation is right for you. And the situation is right for you if you're making a certain amount of profit or more every year. Why? Because there are costs involved in the S Corp that you don't have in the LLC. The costs are a separate tax return. You must go on payroll and I'm talking about you personally as the owner of the business, have to go on payroll, which means you have to hire a payroll service. You have to have workers' compensation for yourself. So you have these inherent costs, and there's some franchise taxes to pay to the state of New Jersey. It could be anywhere from $500 to $1,500 a year. So these extra costs are costs that you do not have to incur as an LLC owner. So why would you want to do this? Because the S Corp has tax benefits. And if you're making, and I'm going to throw a number out, $100,000 or more in profits of your business, it's potentially a tax savings for you. Okay, potentially. It has to be looked at on an individual basis between your spouse's income, the deductions that you have. I mean, you have to run the numbers. Not everybody is a slam dunk for this. There are a lot of people that are, some aren't. So if we run the numbers and we see the S Corp is saving you more tax dollars than what it's costing you in these administrative costs that I just dictated, then it's something you should consider. I have a lot of realtors that are S Corps. Some of them are saving $4,000 to $10,000 every year by being an S Corp. Others not so much. It all depends on how you're structured.
So the question of how does the S Corp save money in taxes? What I'm hearing is that there are some tax benefits.
The tax benefit is that you don't have to pay as much Social Security and Medicare tax if it's structured properly. Somebody that wants to put every single dollar possible into the Social Security system to make sure that then when they retire, they get that high benefit of Social Security benefits might not want to do an S Corp, because the S Corp profits are not subject to those self-employment taxes that the sole proprietor and the LLC entities are. Okay, so by being an S Corp, you are actually saving dollars potentially on the profit of your business from the self-employed factor. But you're also kind of hurting yourself for the Social Security taxes that you might want to get when you retire one day. It all depends on your point of view. I had a client yesterday that said, I'll worry about retirement later. Right now, I have to save every single tax dollar I can. I want to make sure I'm an S Corp because I don't want to pay any employment taxes. Well, this is the wrong attitude because he's not administering his company properly, but it is an attitude that I hear fairly often.
Mm-hmm. Yeah.
Did I answer your questions?
You answered my questions. Yeah, if somebody is not clear on that and you want to throw another question in the chat, please do. I see that.
Okay, so I see there's a question here from somebody named, I'm sorry, I'm mispronouncing this, Eula? Is it Eula? Y-U-L-I-A? Julia. Can you get paid your commission to an S Corp? I thought it has to be an LLC, at least in New York. You have to get paid to your personal name because licenses
In New
are
Jersey,
in your
yeah.
personal name. In New Jersey, correct. In your personal name. So your personal name has to receive your commission income. What you should do if you were an S Corp, for example, is take the commission income and deposit it directly into your S Corp checking account. And then make sure all of your income goes in the S Corp checking account and pay all your bills from your S Corp checking account. At the end of the year, you're going to get a 1099 in your own personal name under your personal Social Security number. And we, as your accountant, would have to report that on your personal return and show the expense of the money going to your S Corp, sort of wash the income out. Make sure the Social Security number matches up with the 1099, and then have a corresponding expense for the entire amount and push it all over to your S Corp. So that's something that we have to do at the tax return preparation time. But now all the income is in your S Corp. Now you can administer that S Corp and pay yourself a salary, give yourself a dividend. If it's structured properly, as I said, it's possible to save thousands of dollars every year.
So Julia is asking, I think it's no. Can I deposit my personal check to the corporate bank account? Check in my name, but into the S Corp.
No,
You're
you
suggesting
deposit
put it into the personal account and slide it over to show the movement of money.
Correct. Absolutely.
Great. And Javier says he needs you. Oh no,
Hi,
it's
Javier.
Xavier. Sorry, Xavier.
Xavier, I'm here.
Yeah, he's here. Okay. Yep, we do have this recording. It's going to be live on inside of our groups. And if you need to reach out to me, just email me at thecoachinglobby@kw.com and I can get you some information. Dean's going to go ahead and provide me with a couple of things that I'm going to ask him for after, especially the suggestions that you had. And what should they be doing right now? I mean, is your firm able to be hired, or do you suggest them to go elsewhere? What do we do with that?
Oh no, I'm very available to be hired. I'm not built to say no to anybody. So I'd be happy to help any real estate agent on this call with their, anything that we're discussing today. I've been doing this for 35 years. I'm happy to help.
Awesome. Dawn, who's an amazing agent, can Dean review my business and how do I get in touch with him? So I guess that would be the question. How do we get in touch with you? Where should we be directing them to reach out to you? Is there an email or a call? What do you suggest?
Yeah, well, I think, Mary Beth, you have my email, and on my email, all my information is on it. My name, my firm's name, my address, my email address, of course. If you want to just send them a blanket, response, fine. Or if you want me to just dictate right now over this call what my email address is, they can do that. It's up to you how you want to go forward.
Go ahead and do that, and I'll also then post it as well. So Dean Symeonides, is that how I say it?
Yeah, so I'll spell you my name. It's not an easy. I have an easy first name and hard last name. So Dean, easy, D-E-A-N. Symeonides, S-Y-M-E-O-N-I-D-E-S.
Mm-hmm.
My email address is deanj, D-E-A-N-J, @BGS. That's B for boy, G for George, S for Sam, hyphen, like a little dash, CPA, certified public accountant.com.
Okay, there you guys go. Dean, is there any last minute things that you think that we didn't cover that they need to know to get prepared?
I think we went over the most important things, which are just hammering down the fact that these tax deductions have to be gathered and not lost. I would say have every agent make sure that they have an idea of what the square footage of their house is compared to their office. Try to gather all the home office deductions as possible, including the costs for their home. Don't wait to the last minute to do all this. And self-employed people, sometimes they procrastinate because they think they owe money and they kind of put this off. Then all of a sudden they're up against the deadline of April 15th. Hey, if you don't pay your taxes by April 15th, you get penalized. So why not do your tax return early? Know what the bottom line is. And then even if you owe more money than you thought you owe, you have a period of time before April 15th to gather that money and to figure it out instead of giving yourself a week or two to do that. So I really recommend you do that. And of course, the retirement account thing, I think is a big deal. And I really want people to try to focus on that as well.
And we'll come back with another session in the new year to talk about that. Right now, everybody needs to get themselves organized so that we finish 2020 strong and we file. Dean,
Yeah,
I
I'll just say
appreciate
one
you.
more thing, Mary Beth. What I'm going to do is, if you like, I have a checklist of certain regular tax deductions
Yes,
that people may want to consider. It's in alphabetical order. I can scan that over to your email and you can distribute it to anybody that wants it. That can give them at least a starting point of what kind of deductions we're talking about.
that would be great. That was asked for. And just to clarify, Claudia, yes, so she said if we were to get direct deposit to our account, then we transfer it to the S Corp account. Yes, that's how you would do it. Show the movement of the money. All right. Well, if anybody who had registered for this, I'm going to have their email. So the stuff that you send me, I will send out to them. And then I also will post it in a couple of places for people to find. But once again, thank you so much for your time. Extremely valuable, extremely timely. And even though it was a snow day, it was a good day, right?
Great. Well, I was happy to do it. I wish everybody safe and be safe, and you and your family. And if I can help out, you know where to find me.
Okay. Thank you so much, Dean. Thank you, Sally. Have a
Thanks,
great day.
guys.
Be safe. Bye, guys.
Bye.